Peter Rose, Longwood Currency Trading. It's about the third week of January, 2022. Still another cold day. I just got in from pulling some wood in for the wood stove, and I was thinking about it. It's a Sunday right now that I'm recording this, and so I'm looking at what's going to happen on Monday, and an interesting thought popped into my head about the trading process itself. And I thought it might be interesting to address the issue of intuitive trading versus mechanical trading. All the educational resources out there are relying on teaching mechanical trading, rules-based trading based on moving average crossover system, Bollinger Bands, back-friggin' patterns, whatever. You're relying on your trading on stuff like just indicators. What is an indicator? What is that telling you? It's all based on what happened in the past. It's not what's happening right now. Now, you say, well, yeah, but an indicator shows you what price did in the past, and so therefore, if it's done it many times in the past, then it could do it again. Well, yeah, but it's not going to form it the same way, because patterns are representations of past economic activity between the two pair countries. Each order is going to be different. And again, the dogs that run this thing are the big institutional traders, not us, the retail traders. We're not running anything. We're just we're the tail in all this that the dog is wagging. Economic activity is not created by the retail trader. Economic activity is a function of economic activity that's conducted between major players, institutional traders trading on behalf of clients. Today it's somebody with a $2 billion order for airplane parts, and tomorrow it's 6 weeks from now, how are we going to import your crop of tomatoes? So you have different people, different institutional traders resolving different clients' requests for different stuff. The only pattern that you can rely on in the currency market is to look back over the course of a 5-year period of time and see what the top price in your currency was and what the bottom price was. Many times those bottoms and tops are really kind of anomalies. For example, the Brexit condition that caused the pound to drop 800 points in a couple of days or something. If you went through that as reactive trading as opposed to normal economic activity, and you look back over that 5-year period of time, where is the bulk? What's the channel that the price action is occurring in? We're trading out on the 4th decimal place as a 1 pip move. But the real activity that causes people to lose a lot of money is out at the 2nd decimal place. So you're going from, for example, if it's the United States, you're going from $1.25 to $1.28. That's that 2nd decimal place. You've gone up 3 cents. So 3 cents on an increase of $600,000 transaction, 3 cents on per unit, that's a lot of money. So when you look at this spread that the currency price has undergone over the last 5 years, it's not going to be very wide. You might find, 600 or 800 pips over that time, and the rest is kind of anomalies, right? So what the economy of those two countries is saying is that they don't want to pay more than this amount unless they absolutely have to in a panic situation. And they're unwilling to sell their goods for much less than this because they have to pay their workers and they have to buy the material, and so that's the best that they can do for a sale price. So that becomes the foundation of what you're going to be looking at in your trading. That's the thing that's constant. It's the economies of those two countries that say, we're not going to pay more than this and we're going to sell for less than this. So we're going to conduct currency in this 500 pip range, 1,000 pip range, whatever that range is in the currency pair that you're looking at. That's your playing field. That's your real playing field. A lot of people say, well, you know, I'm going to go on a 4-hour chart and I'm going to draw support and resistance lines. What does it matter 5 days ago on that 4-hour chart? But 5 days ago, somebody got in there, they did their $2 billion, and they're gone. And this is why I'm not a proponent of indicators or patterns, because patterns change. I've done videos and blog posts on patterns change. Averages don't mean anything. You know, if I told you I've got a 12-foot plank and it's stretching across, I mean, I've got a 6 by 6 plank, let's say, or 12 by 6 plank, and it's stretched between two buildings, and you're 200 feet off the ground, and you have an average width of 6 inches. You've got a width of, a flat width of 12 inches or 24 inches, whatever you want to make it. But your depth of that board has an average of 4 inches. And you go, oh, right, that's 4 inches, that's plenty to hold me up. Yeah, but what if I had 8 inches back here and it stretched out from there to be 1.5 inches, and then you had another 8 or 10 inches the last 10 feet. And you averaged out all those things, you'd average out over to 4 inches or 8 inches or whatever I said it was. Are you going to risk your life going out when, based on an average? Because when you get out to the middle of that board, or even right at the edge, that could be a half an inch. You go right through that. So when you're looking at a moving average, a simple moving average, what's that telling you? Well, on average over the last 21 periods, the price has been this. Great, well, the price has been a hell of a lot more than that, and it's been a hell of a lot less than that, and it's just kind of smoothed out to that. What relevance does that have? Because, you know, well, I'll go to an exponential moving average. Well, you still have a moving average, it's just that you've artificially changed the last third of those prices to be more reactive. How are these things helpful for making a trade right now? Well, they are, but not in the way that you would think. If you've done any sort of trading at all, and I'm not talking about in a simulated account, but if you've done any kind of trading at all, you've tried a moving average crossover system. And what's been the result of that? If you've done that only in long trending periods, you've probably done okay. But if you've done it over long periods and applied that, you're going to run into some periods where you've got some chop, or you've got some spikes, whether their spikes are up or down, or, you know, stuff that you'd end up with a pin bar on. And you get caught. And we all know that moving average crossover systems don't work in range-bound trading. They only work in long trend trading. So why would you look at a moving average crossover system? Because you don't know that you're in a trend until you're about a third or a half of the way through, and you go, oh, I'm in a pretty good trend here, I'm going to follow that. But your moving average system is lagging that trend by 21 periods or 55 periods or whatever the moving average that you're using. So if you've lost 21 plus the last third of that, of time for action, so by the time that thing crosses or has crossed, the actual price that you pay is nowhere near the cross point. That's why you get screwed up and why you have to wait for the long trend. But how do you know how long that trend is going to go? There's nobody that can predict a long trend. And the longer the trend goes, the more likely it is to turn around. And the longer the trend goes, the more likely that the swing point becomes a cliff dive. If you traded for any time at all, you've seen that happen. So if you're trading for the long haul, and longer term that you're trading for, the more pips that you trade for, the more that you're going to experience reversals. The price is going to go up and it's going to come down, and it's going to go up and it's going to come down. So if you're on a 5-minute chart, maybe that makes sense. But if you're on an hour chart, then that pullback could be 20 pips. Well, if you're trading with some heat, 20 pips is a lot of money. It could be thousands and thousands of dollars. You're trading a mini lot, 20 pips is 20 bucks. But as a percentage of your mini lot value, well, that's a lot of money. That's 2%. Gone. So where does this mechanical reliance on mechanical stuff, where does the trust in that come from? If you can't trust that, what can you trust? You have to trust yourself. You have to trust your intuition. But Peter, how do I build intuition without having rules and mechanically go through this stuff so that I can see how it all works? You have to be sure. How did you learn to drive a car? Did you have your driver's rules of the road in front of you as you were driving? Oh, let's see, I'm getting ready to make a left-hand turn at the lights here. I'm supposed to look for oncoming traffic, dogs and basketballs coming into the road. And no. You study all that stuff. That's the what. And you get comfortable with that by learning in a parking lot. So that when you come up to that traffic light and you want to make that left-hand turn, you don't have all these mechanical indicators in your head. You're going to make the left-hand turn. You're going to scan the view and you're going to say, okay, it's safe to make the left-hand turn. Boom, and you make the left-hand turn. You do that intuitively. Does it take you 10 years to do that? No. God, a week, 2 at the most, if you have driver education. So why should it be any different in trading? Well, it shouldn't be, but because everybody's relying on these indicators and drawing all this shit on their charts, you're not paying attention to what you should be paying attention to, which is price. What's the price doing? What's the momentum of price right now in relationship to what it was 15 minutes ago? And if that price momentum change is great, what's the magnitude of the candle that would indicate how much further that momentum may go in the short run before you have a retracement? Those are all the rules that you've thought about and that you've gone through, working with your mini account, with your one single mini account. But look, if you're trading 3 mini accounts and you're staging in and staging out and you're doing Fibonacci analysis, you're wasting your time. Experienced traders are not using Fibonacci as during position management or as they're going. They're doing the trade. They've already got all that stuff figured out. Did they figure it out by friggin' Fibonacci's or patterns or no? They looked at the situation, what's on the ground. Do you think the pitcher steps up to the mound to throw the ball at the batter, and he's worried about what the batter did last inning or last year? He's already studied that stuff about the last year and the year before and last week's game. He's already studied that before he steps up to pitch the ball at you. But he's not running through those calculations now. He's looking at what you're doing. He's going, oh, this looks very similar to what this guy did in the past. I know what he's trying to do. He's trying to knock it out of the park. I know what he's got to do in order to do that. And I know what his capability is by having watched him play before. I'm going to pitch this guy this ball. And the pitcher and the catcher are in tune. They work as a team. When you're looking at price action, you sit down at the trading platform and you look at that price action. If you're drawing moving average lines and looking at support and resistance and all that other crap right now, you're looking at the wrong thing. You're trading mechanically. Remember, support and resistance is not lines. You don't have a resistance line. It's a zone. If you have a resistance line that's drawn off of the daily charts, that zone could be 10 pips on either side, 20 pips. If you're drawing the zone on a 5-minute chart, you're probably going through an ATR. I mean, you know, they're useless as mechanical indicators. What they should be is intuitive markers of what's happened in the past. And what is it that happened in the past that caused that resistance or support line zone to be there? Economic activity. So how much economic activity has been going on over the last hour? Because are people in there banging away and creating that activity right now so that it is predictable? Or are you trying to trade it at 12 o'clock when everybody's out to lunch, or when it's late in the day? The big institutional traders are not trading at 3 o'clock in the afternoon. They're wiping up the mess. They're getting out of bad shit. The majority of the trading is going on when the early part of the day, or a combination of the early part of their trading day and a good part of the pair country's trading day time frame, right? So if you're trading off hours, I'm on the East Coast of the United States. What am I trading at 6 o'clock at night? Am I trading in Europe? That's 5 hours ahead of me. So it's 6 o'clock here. It's 11 o'clock in Europe. Who's banging? What institutional trader is banging away at 11 o'clock in Europe? Now, there may be somebody in Australia that's trading the pound or whatever, and so as a dollar trader, I could maybe look and jump onto that, or trade Aussie Euro. But what are you basing your trade decisions on? I mean, that's a whole other study. I'm just talking about sitting down, and are you going to trade because of a moving average combined with a fib and a resistance line? Is that what you're doing? Because you're not becoming a trader that way. You're becoming a recipe follower. You have to use your intuition. How do you build your intuition? Jesus, let me say it again. This is the 174th video or something that I've done. Let me say it again for the 170th time. You start with a mini account, trading one mini at $1 a point. And you trade that until you become consistently successful with no large gains and no large losses. You're consistent. Your equity curve is consistent. And when it's consistent, regardless of whether that consistency shows an average per trade value of 3 pips or 8 pips or whatever the Christ is, doesn't matter. It's consistent. And so you can go based on that, and based on your win-loss ratio, which is a critical ratio, you can then use your intuition based on your experience to make the decision in real time as to what you want to do without farting around with fibs and support lines and all that other stuff. That becomes background stuff. If I'm playing football, whether that's soccer or American football, what's the thing that's in the background? I'm busy doing what I'm trying to do, but when does that change? When somebody blows a whistle. That means stop. Everything else, all I'm doing is reacting in real time to the situations that are being presented. I don't care if this is the 85th time that this guy has run the tight end is run around this way, or it doesn't make any difference. What's he doing right now? I could be in there and I could say, look, this guy has a proclivity of haul-assing around the left side of the line, and he's real good at hitting that line right at the hike. But is he going to do it this play? I don't know. I don't know what the play is going to be. I don't know what the price is going to do in the next 15 seconds, let alone the next 2 hours. But what's it doing right now? What did it do 15 seconds ago? What time frame am I looking at? If you're trading up on the daily chart, you don't have any of those issues, because you're either in or you're out. You're not worried about all this stuff. The danger, though, is, oh, I'm going to go in on a daily chart trade and I'm going to be looking for 300 pips. What's the likelihood of you getting 300 pips? Well, if you're not measuring where the total economic activity comes through and you're trading in the top quarter of that, why would you be trading long? Because you don't know when that thing is going to pitch pole over and come back down. And how much of a retracement are you willing to take before you hit the stop? Assuming that your trade entry is good and you get in without getting a stop at entry. What are you going to let it come down? 20 pips, 30 pips, 50? You're looking for 300. You got to give that price room to breathe. ATR on a daily chart, anywhere from 100 to 120 pips. You're going to let it come down an ATR, 120 pips? You're up 100 and you're going to let it come down 120 pips, an ATR? You know, that's what Richard Dennis taught his turtles. It was I think it was a 2 ATR drop or a 4 ATR drop, whatever it was, and that they'd get out. They lost horrendous amounts of money. But when they had that thing run on and on and on and on and on, dropping a 4 ATR was nothing, because they had made 8 or 10 ATR, 20 ATR. But even Richard Dennis today says that isn't going to work as well in today's markets, because you don't have these really long trending markets, particularly like in the commodities markets, because there's more institutional trading going on and they're trying to limit the price. You guys are trying to get the best price, these guys are trying to get the best price for their sell. So those spreads, not the transaction spread, the bid ask, but the actual spread of the economy gets smaller as information about those two countries increases. And so, as a retail trader, are you going to try to compete with the information and knowledge and stuff that the guys trading up on the dailies have at their disposal? And the way that they're trading is totally different than the way you're able to trade. So you can't rely on the mechanics of it, because the mechanics are not going to be viable for you. They're not going to be viable for you on the long term, and they're not going to be viable for you on a short term. I've tried them both. I know the difference. The fact that I trade short term is immaterial to you. You can trade long, if you understand, you can trade long term and you can do fine. The reason I don't do that is because I'd rather take a short stop and get out and take another run at it. My personality just isn't geared to want to try to get 200 pips. I'd rather get 20 pips a day, and or 10 pips a day, and do that over every day. Say I trade for 20 days in the month. There's 20 trading days. Maybe I'll get that 10 pips 10 days. I made 100 pips. The guy that's looking for the 200 pips, he may make it, but more often than not, it's going to have a reversal. It's going to come back. What's he willing to take? A 20 pip drop, a 50 pip drop? I mean, those are questions I can't answer for you. It's how you define your risk tolerance. But you better have your risk tolerance aligned with not doing mechanical trading, because if you do that, you're absolving yourself of the responsibility to trade and saying, oh, I'm at the 38 fib level and blah, 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 blah. You can't do that. You got to take responsibility. It's my intuition, it's my experience that leads me to believe that if I get into this trade now, I can get 10 pips or 200 pips. That's the decision that I make. Not because of, but it's the decision that I make based on the environment, the intuition, and the look of that environment. If you want to read a good book, Curtis Faith wrote a book called Trading on Your Gut. Curtis Faith was one of the most successful of the turtle traders. The fact that he's an asshole and he invested in businesses after the turtle trading thing and he went broke and all that other stuff, it has nothing to do with it. The fact is that he made a lot of money for Richard Dennis. He made a lot of money for himself too. But he comes away from that experience and talks about the difference between your gut and trading from your gut is what he's saying. And I've done a video on the difference between intuition and gut. And there is a difference. And you'd have to read his book to kind of get an idea of what he's talking about. And then you can look for my video where I discuss that. And I'm not exactly an idiot about stuff like this. I've got a 40-year career as a real estate investor, over 30 years as a senior software engineer. I've got a bachelor's in physics, almost a minor in math. Done martial arts for over 50 years. When I was in college, I studied psychology and abnormal psychology and philosophy, and so I'm well versed in all the nomenclature and all the theories and stuff that's going on. And if you define these terms, intuition, gut, mechanical, if you define them clearly, then you could step back from the big landscape. You know, like if you're looking at my wife's photograph that she took here of this wagon wheel, if you get up really close, you're right in and seeing the detail of the berries and stuff. And you step back from it, you know, it's like looking at a scene up on a snowy hill. So she took that not because she was looking at light conditions and the position of the vines correct, and is the snow just right, is the light. She had an intuitive feeling for that and took that picture. And that's why she was a successful photographer, because she did it on her intuition based on her experience. But if you ask her, well, give me the correct ratio when the light is blah, 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 blah between your ISO and your shutter speed, she'd go, I don't know. Because what's important to her is the composition. That's what makes the photograph, is the composition. Not the shutter speed or the ISO. Those could be any, what are you going to do? Oh, I got an ISO of 430. An ISO of 438. What difference does it make? It's the composition and the feeling about what the light is and the feeling about what the ISO should be and the approximate shutter speed. But it's the composition. And the trading is the same way. Don't get so wound around the axle about the resistance line and the moving averages and fibs and all this other crap. It means nothing. It's all what happened in the past. What are you going to do right now? And that's going to be based on your intuition, not your ability to gymnastically control a bunch of mechanical indicators and react to the indicators. You should be reacting to the price, not the indicators. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.